Hello everyone, this is Tejashwini. In today's classes, let's try to understand and let's make a revision of PGBP. Okay, so in case of PGBP, profits and gains from business and profession, you need to understand one thing about it, that is, whatever the gains, whatever the profits which you are getting either from business or profession, that would be taxable under the head PGBP. Only that income, only your business income, in short, your business income would be taxable under the head PGBP. So now, whatever the expenses which are debited to P&L, but it is not allowable as per your income tax, that would be added. What would be added? That is what income not credited in the statement of P&L, taxable under this head will be added over here. In order to understand this, you need to understand something with regarding to accounts here. Okay, see, try to understand. When it comes to your P&L, like let's consider you record the sales of some 10 and there are some expenses of some 6. Just an example. How much would be your profit, people? Profit would be 4. Okay. So let's make a small changes here. Let's consider your expenses has been increased to 7. Your expenses, your expenses increased to 7. So what would be your profit that you would record? Your profit would be decreasing by 1. That is your profit would be 3. So can I say if your expense increase, your profit decrease? Correct. So now let's take another situation. Let's take a different situation. That is, what if your expenses decreases? If your expenses decreases, your profit increases. No. Instead of 4, it would be 5. Correct? So, can I say if your expenses decreases, your profit increases? What would happen to sales? If your sales increases to 11, your profit would increases by 1, that is 5. Can I say if your income increases, your profit also increases? The opposite effect, that is income decreases, profit decreases. This is the effect that you should clearly understand in case of your PGBP, that is your profits and gains from your business or profession. Clear? Sales, that is income increases, profit increases, income decreases, profit decreases. Expenses increase, profit decrease, expenses decrease, profit increase. These are the two effects which you need to understand very, very clearly. Yeah? No. So the same effect. See, if expenses has been allowed as per your P&L account, suppose let's consider is expenses of 6 which you are recording here. Suppose this expenses of 6 is splitted as 5 and 1. Just let's take an example. Let's split this as expenses is 5 and 1. 5 is one expenses and 1 is another expenses. Where total expenses is 6 which is allowed as per your P&L. But as per your income tax, let's imagine this 5 is allowed, this 1 is not allowed. What does it state? Your profit should have been 5 because this shouldn't be recorded as your expenses. Correct? So, what you should do now? Your profit, what you should do in your income tax? You should decrease your expenses that would result in profit. Okay? Array, all of us know as this is revision classes, this is assumed this video is being watched after doing your classes regularly once. So, I'm considering you guys know the basic points of it. So net profit would be your total. That is net profit would be your starting point in case of your PGBP, right? Net profit would be your starting point. So whatever effect that you're going to take in your expenses and income, that should be given effect with regarding to your net profit on. If you're decreasing expenses, that result which it has is in your profit. No? So can I say if the expenses is decreased, profit is increased means my effect of profit is increasing. No. So my profit, my net profit is 4 and increase effect which is happening is 1. So my PGBP income would be 5. Clear? Suppose in your P&L account also you wouldn't have recorded this one. Your profit would have been 5 only. No. This is the same effect that you're giving in your income tax. That is when your expenses are decreased, your profit increases. Expenses increases, your profit decreases. Clear? Suppose expenses is allowed as per P&L but not allowed as per your income tax. You're going to decrease your expenses, you're going to increase your profit. Expenses is allowed as per P&L but not allowed as per income tax. That is That is, expenses should have been considered in your P&L, but it is not considered. Expenses have not been debited, but it should have been allowed as expenses as per your P&L account. It is considered. That is, expenses increase, profit effect you would have decreased. Clear? Detailed version of this would be usually done in the regular classes. As this is revision classes, we are keeping it very short and sweet. Huh? Clear. Similarly, if your income, suppose you should have given some income in your P&L account and which is taxable as per your income tax, but you omitted. That is, you did not record, you forgot to record your income over here, but it is taxable under your income tax. So now you would increase your income. If your income increases, your profit increases, you would add that in your PGBP, income tax. Suppose there are certain incomes which you have recorded here, but it is taxable under separate head. So, rent received, it is going to be taxable, but it is going to be taxable under different head. That is income from house property, not under your PGBP. So, income decreases, profit also decreases. What you would do? Minus. Clear? So, this is the effect that you would consider over here. Now, when it comes to your PGBP, that is the basic idea with regarding to how you are going to consider your PGBP. That is how you are going to add or how you are going to subtract something in your PGBP. So, business and profession. Business means something that is wherein you're trading goods, wherein you're manufacturing goods, that would cover under the business. Profession would include basically the act of giving the services. Certain services you're providing, that would basically be covered under the term profession. Okay. Section 28 speaks about the charging section, that is, which are chargeable incomes which are chargeable under this head. This covers income from profession, whatever the compensation you have received, any profit on sale of imports, customs duty, any benefits which has been received as perquisite as a benefit, some due received by the partner of the firm, Cayman insurance policy. All these points are to be considered under your income. That is as under the head that this should be taxable under the head PGP. Clear? See, speculation business are such business wherein your actual delivery of the goods doesn't happen. Every actual delivery of the goods doesn't happen. It is just that you're going to do some trading over there where you're trying to get some profits. That is your speculation business. Now, when it comes to your section 29, that is the computation of the PGBP. PGBP is divided into multiple sections. That is 30 to 31 would cover under what are the expenses or what are the deductions that you can take under your income tax. Inadmissible deductions are such that wherein you can't take such expenses as deduction under your income tax and also in special circumstances. Okay. This admissible deduction start from section 30 to 37, wherein section 30 speaks about the rents, rates, taxes, repairs, and insurance of the building. And the owner, that is, if I being a tenant, okay, first let's speak about tenant. I'm a tenant, I'm paying rent. I'm paying some rates and taxes. That is, I'm paying taxes for the building. I'm paying for the repairs of the building. I'm paying for the insurance of the building. All these are revenue in nature, no? All these revenue expenses would be considered as my expenses in my PGPP also. That is under my income tax as well. But what about the owner paying it? Correct. If the owner incurs some expenses that I being a building, that is I being a building owner. If I am the building owner, there is no concept of rent paid over here coming for the owner. So apart from that, other costs and repairs I would be incurring, insurance of the building I would be incurring, and all those things will be allowed provided it is revenue nature. Suppose you being a owner of the property and you have capitalized it. Capitalization of your expenses would result in getting depreciation. Would result in getting what? Depreciation. The depreciation you would take as expenses in your PGBP and get the expenses deduction over the period of time. That is, profit would be reduced over the period of time. That is for depreciation. But in case of these, if you're treating it as revenue, what is going to happen? Revenue nature, only revenue nature you would get deduction. Capital nature you will not get any full deduction. You will get indirectly in the way of depreciation. Clear? Repairs and the maintenance of the machinery and building. So this repairs and the maintenance of the machinery, that is machinery, machinery, plant and furniture for that matter, this would be allowed as deduction provided it is used for own business purpose and it is not capital in nature. Okay, then next comes a very important section which speaks about the depreciation. See, depreciation, whenever you're considering, all of us know depreciation as per the P&L account, you're going to add back. because that is not going to be allowed. That is going to be disallowed. Whenever you are doing the disallowed, it is always the concept of disallowed will be add back of the expenses. So minus the depreciation as per the income tax, this would result in PGBP. Clear? Deduction on account of depreciation shall be made compulsory. See, remember, depreciation is something which should be claimed compulsorily. It's not an option which is given to you stating that you can take this, you can't take this. No, it is 100% of that you have to take it compulsorily. Clear? Now, remember, in case of the conditions that need to be satisfied for the depreciation, if it is less than, that is depreciation, that is the machinery, the asset which has been purchased, the asset which has been put to use for a period less than 180 days, whatever is the depreciation which is allowable, half rate of depreciation would be allowed. That is, let's consider plant and machine at 15% is the depreciation rate. Half of the depreciation allowable would be 7.5% of the depreciation is allowable. 50%, half of the depreciation which is allowable under the block which we see. If the asset has been used for a period more than or equal to 180 days, full rate of depreciation would be allowed. Remember, this use can be both passive use and active use, and this half rate of depreciation concept would go only in the year of acquisition and not in the further years. See, whenever it comes to depreciation, there is only one method that you need to follow, WDV method. An option is not given to any other undertakings other than power sector undertaking. Power generation undertaking has two methods, straight line method and WDV method. Any one method they can opt for. But if I'm opting, I being an automobile industry, I being some electronics manufacturing industry, I being a trading industry, I being in service sector, anything for that matter, my machinery, my asset shall always be subject to depreciation under WDV. That is WDV method only you can use for the block. Clear? See, block of asset for that matter. Assets are of two types, that is tangible assets and intangible assets. Clear? There are two sort of asset, that is tangible asset and intangible asset. Tangible assets records machinery, whatever it is, where you can touch and feel machinery, plant, furniture, everything combined. Intangible assets combined basically, which you can't touch and feel basically. These are patents, license, trademarks, copyrights, etc. See, tangible assets, very important point which you need to understand over here is building. Building for residential purpose except for hotel and building, this is going to be considered at the rate of 5%. Now, when it comes to your buildings which are not used mainly for residential purpose and not covered under the block, which is general category, wherein I've recorded it here as the main portion, that would be considered as the important part. That rates should be mandatorily remember. See, in your exam, they are not going to give you all those rates and all. You need to remember the rates by yourself. So, building general category 10%, and this temporary structure or the wooden structure, temporary structure would cover 40%. Furnitures and fittings in general category would cover how much? 10%. Motor cars in general covers 15%. All the things you can give a read, but which is important I'm going to cover. So specified pollution control equipment, control board, solid waste, etc. and resource recovery system would cover 40%. And this computer, including computer software, would include 40%. The books include 40%. Plant and machinery, which is general rate, would include 50%. And intangible assets would include 25% as your depreciation percentage. Clear? Now, next concept which is very, very important is additional depreciation on plant and machinery acquired. First of all, additional depreciation, the rate of depreciation would be 20% of the actual cost of such machinery. And depreciation, remember, additional depreciation is allowed only in case of normal provisions, not in case of default tax provision. Normal depreciation is allowed under 115 BAC also, under the regular provisions also. But under your 115 BAC, you can't claim additional depreciation. You can claim only the regular depreciation. Clear? So, additional depreciation is allowed. First of all, additional depreciation is allowed only on new plant and machinery. That too for the manufacturing unit only. If you're a manufacturing unit buying some furniture, you can't take your additional depreciation even though you're coming under regular provision. Remember, it has to be plant and machinery only, and you have to be in the business of manufacturing or production of some goods or articles only. And you have to consider regular provisions only. Only then you can claim 20% of the actual cost of machinery as the depreciation. And this additional depreciation, remember the term itself is stating it's additional, which means it is over and above your normal rate of depreciation. And the asset which is used shall be less than how many days? 180 days. If the depreciation, if the asset is used for a period of less than 180 days, you will get 10% of the depreciation. Maximum depreciation allowed as additional depreciation is 20%. No, out of that 10% is allowed if it is used for put to use for a period less than 180 days. If it is equal to or used for a period more than 180 days, then 20% of the depreciation which is allowable would be considered. That is 20% of the depreciation. Suppose you consider this year less than 180 days as 10%, you will take additional depreciation. Next year, remaining 10% can be taken in the next year. And that too, remember, it will not be on the WDV, it will be on the actual cost of the asset. Clear? Now, plant and machinery, suppose you are buying a plant and machinery only, being a manufacturing sector in a regular provisions, but plant and machinery is not qualifying for additional depreciation would be. That is second hand plant and machinery, which is installed in the for office premises, installed in the residential accommodation or in any guest house. If any road transport vehicles, which is your motor vehicles or that is motor cars, etc. Plant and machinery where the actual cost is already considered as deduction. In all these situations, there would be no additional depreciation. Clear? Now, if you want to get the notes of all these things, it is available in the Telegram channel. You can go and join over there. Clear? See, terminal depreciation and which is the money payable. The actual cost 43 subsection 1 speaks about the actual cost. That is, actual cost would incur what? Actual cost of an asset of the assessee. See, what would be the actual cost for the purpose to consider? Depreciation. See, depreciation, if 1 lakh into 10% would give 10,000 depreciation. Suppose if that actual cost of asset changes to 1,50,000, my depreciation would be 15,000 then. So my depreciation is directly dependent on actual cost of asset, and determination of how this actual cost of asset is considered is very, very important. Yeah. Now, actual cost of asset, remember there's a section called as 40A3 wherein cash disallowance would be considered. If you're making a payment in cash, that is, if you're making the payment other than account pay check, account pay draft, or any other electronic clearance mode, that is apart from phone pay, GPay, your bank account, apart from your bank details or account pay check, account pay draft, if you're making some payment in cash or in other than account pay check, account pay draft, then whatever the cost which is considered, that would not be considered as your actual cost. Suppose out of 1 lakh rupees, 80,000 rupees has been paid in account pay check and 20,000 rupees, let's 1 lakh rupees, 80,000 rupees has paid in account pay check and 20,000 rupees has been paid in cash. Now, 80,000 would be considered as my actual cost of asset, not 1 lakh, because 20,000 would be disallowed. You will not add it to your actual cost of asset. Clear? Done. Now, when it comes to your written down value, how do you consider your written down value of the asset? See, the format goes very simple. Whatever is the WDV of the current previous year, relevant to previous year, you are going to consider the WDV. No. If you want the WDV of the current previous year, you should know the, suppose in the question, which the relevant PY for us now is 23-24, correct? So, if they have given in the question, the WDV as on PY 22-23 is 10 lakh and the depreciation for the period 22-23 is 6 lakh. So, let's consider 4 lakh. How much would have been your opening WDV? 6, no? So, in the question, if they provide the WDV of the previous year, opening balance of the WDV of the previous, of the preceding previous year, that is before the previous year, if they have given, look for the depreciation for that year. Immediately preceding the previous year, take the depreciation and you should always come to the WDV of the current relevant previous year. Then you would add the whatever the assets which is acquired during the previous year except goodwill. Goodwill, there is no concept of depreciation for the goodwill, it's removed, so we are not going to take it. And for a period which is equal to or more than 180 days, and if the period is less than 180 days, both are considered. If the period is equal to or more than 180 days, you are going to make it as a separate category because 100% of the allowable depreciation would be considered. What about the period less than 180 days? 50% of the allowable depreciation would be considered, so that we are going to make a separate category over here. Less whatever the money receivable in respect of the assets which are sold, discarded, demolished, etc. Whatever the asset which has been completely removed, we are going to subtract from that of your WDV. Remember, when it comes to your SIT, which is being considered in your income tax, there is no individual recognition over here. Everything comes under the block. Everyone, everything gets relevant under the block. So there is no separate thing. There's no separate individual recognition. Next, WDV at the end of the year you would get before depreciation. Then you would calculate the depreciation. Whatever the WD which has been arrived, then you will consider whatever is 100% of the depreciation allowable, 50% of the depreciation allowable, you will consider. Then WDV at the end of the year after depreciation, you would get. Clear? This is your WDV, written down value method. When it comes to your composite rent, remember the composite income. That is, when it comes to your agricultural income, you have a certain places wherein 25%, 75% is considered, 35 and your 65 is considered. That is, your 60 and 40 is considered. So, where there are certain situations where the composite income is being considered, that is certain portion for taxable as business income, certain portion taxable as business income, so certain portion taxable as agricultural income. Agricultural income, however, is exempted. In case of your business income, it becomes taxable. That composite or business income you are going to consider only after reducing all the sort of expenses. All these sort of expenses you will reduce, last income which you will get, on that you are going to make an apportionment as 25% and 75%. Remember, not on the turnover. The 75%, 25% criteria, if you are segregating, then it will not be on the turnover, it will be on the profits. Remember, that is what composite income stated. When you are setting off the depreciation, you should always remember, first you should set off the current year depreciation. Then you should set off your business loss. Then you should set off your unabsorbed. At last, you need to absorb your unabsorbed depreciation. Clear? When it comes to your section 35, that is expenses on the scientific research, remember, scientific research expenses, 100% of it is going to be allowed as deduction, provided you satisfy the condition and there are certain good points. See, section 35 subsection 1 clause 1 speaks about the revenue expenditure, which if you want to claim deduction under this section, first of all, it has to be for the purpose of business, and current year revenue expenses, everyone is going to take the relevant deduction. But here the point comes wherein you are going to take 3 years. Suppose you have started your business in PY 23-24 and 3 years prior to that, that is PY 22-23, 21-22, 2021. 3 years prior to this, whatever salary or remuneration that you have paid to the scientific research team or staffs, and whatever the raw materials which they have used for the purpose of doing the research, these two only will be allowed as 100% expenditure in the year in which you start your business. I hope it is clear. Now, when it comes to your capital expenditure, listen, everyone, listen. Capital expenditure. Capital expenditure is allowed as deduction. First of all, no capital expenditure comes under your P&L, remember. But there are certain situations wherein capital expenditure is allowed as deduction under your income tax, because government wants to promote those sort of business and those sort of activities. So capital expenditure which is relating to the business incurred prior to the commencement of the year, same thing, 3 years immediately prior to that is also allowed as deduction. Clear? Now remember, all the capital expenditure is allowed as a deduction under section 35 except for land. Land is going to be disallowed. Land will always be disallowed as your capital. It is not considered as your capital expenditure deduction. Remember. Okay. Now, whatever the amount, remember, if there is deduction which is given, there would be no depreciation that would be allowed. Deduction given, no depreciation allowed. Deduction given, no depreciation allowed. Please remember this point. Okay. Whatever the amount which is contributed or paid to section 35 subsection 1 clause 2 and this section subsection 1 clause 2a, section 35 clause 1 section subsection 1 clause 3, section 35 2AA. Whatever the deductions, whatever the contributions which you have made under this head, 100% of that amount is allowed. You pay 10,000, you will get deduction of 10,000. You pay 20,000, you get deduction of 20,000. You pay 50 lakh, you get deduction of 50 lakh. 100% of that is allowed. See, section 35 subsection 1 clause 2 speaks about whatever the contributions which you have made to a research association or research team or a university which does this scientific research. This section speaks about wherein you making a contribution for the company which is registered in India and their main objective is to do this scientific research and development. And section 35 subsection 1 clause 3 speaks about research association for the research in social science or statistical research, university, college or institution wherein these contributions you are making this contribution to the place. Section 35 subsection 2 AA speaks about national laboratory, university, Indian technology. You are going to do the calculations for this. Clear? I hope this is very, very clear. If you're making a contribution to this, whatever amount you paid, it is going to be allowed as 100% deduction. Now, next. Section 35 AD speaks about you making an investment in this specified business. You making investments in your specified business, and this specified business is considered as the investment linked to the, that is, the specified business wherever you are investing, you are going to get some tax benefits. That is, you are going to pay less tax over here. How you are going to see this list of specified business being provided? This list is as it is. If you are making investments in this business, if you're doing this business, you will be classified under specified business category. That is cold chain facility, warehousing facility, this natural gas pipeline, this one a hotel star of 2 star or above, building or operating a hospital, developing and housing project, etc. Fertilizers. Out of this, what is going to be important is this cold chain facilities and this warehousing facilities, this production, this setting up and warehousing of this setting up and warehousing of the sugar. These are the most relevantly asked, and other things you can just give it a one time read. These points, cold chain facility, warehousing, warehousing of sugar. Remember, these comes under your specified business. Warehousing of your edible oil. That will not come under your, remember, that will not come under your specified business. This becomes your normal business. Normal business will not get your capital expenditure deduction, whereas your specified business gets your 100% of the capital expenditure as your deduction. Clear? What it gets? It gets 100% of the capital expenditure as your deduction. Clear? Great. So you're going to get this all this point as your deduction. And remember, if you're getting deduction under section 35 AD, then you can't take the deduction under section 10 AA. If you're getting this, you can't get that. If you're getting that, you can't get this. And loss, set off of loss and carry forward of this specified business, there is no time limit at all. That is, there is no time limit of you. There is no time limit for you to state, okay, this has to be set off within 8 assessment year, 4 assessment year, nothing. Specified business setting of period is indefinite. We more about it. You can see that in your the chapter of your set off and carry forward. Okay. Section 35D speaks about the amortization of the preliminary expenses. This amortization of the preliminary expenses which has been provided, that is to Indian companies and other resident non-corporate taxpayers, that is other than Indian companies for that matter. Basically Indian residents, other residents, non-corporate box, this non-corporate taxpayers. This section applies to Indian companies and this particular parties, and the amount which is eligible for deduction would be 1/5 of the specified, that is 1/5 of the qualified limit amount would be allowed as deduction. How would you calculate what are the expenses that is covered? This feasible report, project report, etc. First of all, this preliminary expenses means expenses which is incurred prior to commencement of your business. That would be considered as your preliminary expenses. This includes this feasible report, this project report, this surveillance, this engineering services, legal services, printing of MOA for registration, all this basic amount which you would have spent, this is allowed as deduction as your preliminary expenses, but not 100% will be allowed. That will be considered based on the overall limit. That is 5 years you are going to get that 1/5. That is whatever preliminary expenses incurred. That is for your resident non-corporate associates. 5% of the cost of project would be considered as your limit. Okay, this expenses incurred or 5% of the cost of project, whichever is lower would be basically considered. Of that amount, you're going to get 1 by 5th. Suppose your 5% of the cost of project would result in 50,000. Suppose this 50,000 or 1 by 5th, 50,000 divided by 1 by 5, that is 10,000 would be considered as my deduction every year. That is starting from the current previous year to the next year. That is starting from the current assessment year to the next assessment years you're going to get. Clear? That is in case of Indian companies, 5% of the cost of project or 5% of the capital employed, whichever is higher, you would get as your done. So cost of project means expenses incurred. What would be considered as your cost of project? Cost of project means expenses which are incurred before the commencement of the business, or the expenses which are incurred for the extension of the business or setting up of a new unit. This too will be considered as the cost of project. However, capital employed includes the share capital, debentures, long-term borrowings, etc. Done. So audit of accounts basically, if you are coming under the company category, subject to where you are subject to not company category only, where you are subject to tax audit, your due date would be 31st October of the relevant assessment year, or 30th September of the relevant assessment year on or before this one. They have considered something called as a specified date over year. Okay. This was an amendment for your September attempt also, for your September attempt, wherein it was stated if you are taking deduction under section 35D, now you have to furnish a statement of an expenditure in connection with these things to the department, and amortization to the income tax department. You need to provide the information, and this has to be submitted 1 month prior to the due date of furnishing of the return of income as specified under section 139 subsection 1. That is, you need to specify, you need to submit it on or before 30th of September. Your due date is 31st October, no? So you need to submit it 1 month prior, that is 30th September you need to provide. Section 35 DDA speaks about your voluntary retirement scheme. 1 by 5th of the amount is allowed as your deduction.